Got it. Got it. Well, let's dive right into this. So, instead of kind of giving a little bit of a real estate update, which I still will, I kind of wanted to give you a little educational piece as well, which I'll have Steve chime in and kind of help me out with the numbers because he's my numbers guy. So, we are starting to see listings go up and they're starting to tick up at a substantial rate, 5-10% year over year, month over month. So we're seeing these new listings hit the market, but our inventory continues to stay the same. And the reason is because that is the demand for the new listings is rising with it. So if we have let's say, I don't remember the exact number, if we had a 5% increase in listings, we have just that many buyers that are coming into the playing field right now and making that absorption rate, which what that means is the number of homes that come on the market compared to the number of people that are buying them they're raising together. So it's continued to make, especially here in Metro Detroit, that inventory stay at an all-time low, under 2 months right now, and that's why we're continuing to see the days on market go down, and prices still continue to rise. Right now, we're kind of sitting at a space right where home affordability is at its all-time low, meaning your monthly mortgage payment is at an all-time high. And even though interest rates are down from what they were in the last quarter of last year, because houses are appreciating at such a fast rate, it is now affecting that. So if we take a look historically at home prices, they are on a line going up, right? With a few exceptions. But with mortgage rates, we have a bait. Crap, we hit. Oh, I'm losing myself here. Let me put this back. Technical difficulties. Once again, let's see. Let's hit my video. Okay, I'm back. So mortgage rates are kind of on a line and they go like this, right, Steve? And
Yep.
so there's a baseline that's an average and they're always continuing to go up and down, but they stay close to this baseline. So people that are playing the market based on interest rates are playing a risky game because when they're waiting for that interest rate to drop below a certain point, their home that they wanted is now worth way more than it was maybe last year. Right, Steve?
Exactly. And that's, I mean, I have that conversation every day about, hey, we're going to wait on rates. But at the same time, there's a millions and millions of other people doing that. So as rates go down, or as more desired homes come on the market, there's more and more buyers for that particular property. So the best way to avoid competition for a property is to buy something when rates are high, which you're like, that doesn't sound fun to me. The upside to that, though, is that when you buy when rates are high and you're able to secure a price for the home that works for you, you can afford the payment, even at those higher rates. You can and people get so caught up in refinancing. Like, you can always refinance. Refinancing is not that hard to do. Sometimes, are there closing costs? Yes, there are. But guess what? The bank will lend you the money for the closing costs, and then they'll spread out those closing costs over 30 years. So, a lot of the feedback I get is like, yeah, but then I'm paying this cost over 30 years. It's like, well, yes, you are, but you're paying that cost over 30 years at a savings of potentially 1% on $250,000. So you are paying extra because you financed, let's just say, $3,000 in closing costs, which is going to cost you somewhere around $22 a month. However, you're saving yourself $2,500 a year. So so when I go through this with the buyer, I'm like, okay, so here we are. This is what your interest rate is today. I don't know that. I don't know if I want to buy until rates go down. Well, look, here's what rates will be then. Are you going to have a problem with letting the bank finance your closing costs and saving $200 a month? No. Why would I have a problem with that? Of course you wouldn't. So if you can afford the house now, and you can get a house that you like in an area that you want to move, and you can make these payments, then the opportunity to save will 100% present itself. The one thing that won't present itself is the price for the home, because over time, and there's like some very, very small increments of time where prices went down or home values went down, like very small. We think about it all the time, and there's a lot of these home crash, price crash people out there. You have to understand, the last time we went through that was like 2010, 2011. That was like 11 or 12 years ago, and everybody
Mhm.
remembers it like it was yesterday and like it's going to
Right.
happen again. We're just in
Right.
a much, much, much different place. And it would take the government and employers and the governing bodies around mortgages learned a lot during that time. And they learned a lot again during the pandemic. If everybody remembers the forbearance and loss mitigation and loan workouts, that will prevent a crash from like that from ever happening again. Right. And
Right.
so you have so much demand, you have so much regulation, and you have so many jobs and so much money in this economy still that the values of homes, even if the rate of appreciation cut in half from last year at 5%, your $250,000 home is going up $25,000. Or I'm
Right.
sorry, $12,500 over the next 12 months. You're still going to gain that appreciation in that home. So, waiting on the rates or seeing that graph with the rates that goes like anytime that you see something going up and down and you're comparing that to the price of something that's going up, you always want to play the average of the up and down, not the going up, if that makes sense.
Yeah.
And
Yeah.
that's just like standard supply and demand economics.
Yeah, exactly. So if we have this pool of people that are waiting until interest rates go down to put their feet on the ground. And what's going to happen when that does happen is if, when interest rates do go down and we have all these people that are rushing to go get into inside homes and we're still sitting at this inventory that's low, we're going to be even in a worse situation where prices kind of skyrocket and we're in this insane market because there's been so many people just waiting to burst out into the market. And then you're right back in the same position as you were. Oh, I'm lost again. I need to change this up. There we go. Okay. Don't
So
mind.
something else to keep in mind, right? In quarter two, which started on Monday, um, you are we are going to see likely the first rate cut from the feds. So it may and it may not, but I do see the first one happening here in quarter two.
Mhm.
And when they do that, it's going to make very little difference on the mortgage market. It'll make very, very little difference in the interest rate market. Other than like maybe like a little bit of tightening of the yield curve, we might see rates go from like where we're in the high sixes now to maybe like the mid sixes. But because that is for a seller of a home, there is no there is no other more powerful marketing mechanism to drive people to your home that's listed for sale than the Fed coming out and lowering rates, regardless of what it does for mortgage rates. And there's a chance that the Fed could lower the rates 0.25%, go in their press conference and say, we just want to see what happens. If inflation goes up next month, we are going to raise the rates again. If they say that, rates will go up that day instead of going down, even though they lowered rates. But the fact that the Fed comes out and they announce that they're going to cut the Fed funds rate 0.25% will take an exponential amount of people off the sidelines. And they're like, rates are going down. I'm in the game. And so that's going to be that's what's really going to start to pressure this housing market even more.
Yeah, absolutely. Anything else you have to add, Steve? I know this was a little bit of a different video because it was more educational than an update, but I just had
Yeah.
to get that off my chest.
Yeah, I mean, there's been a lot of, since we've been on here, I was on vacation and then I got man flu. If anybody knows about man flu, I mean, I don't know a lot about like third world illnesses, but I am pretty sure I had a brush up with lethal malaria as part of my man flu. It could have been a cough. I don't know. It seemed like Robitussin fixed a lot of it, but I was talking to God. Okay. But during that time, we had a lot go on with rates. So we had the Fed meeting. Fed basically said that, look, we're going to hold our rates steady, but our plan is to still drop or decrease rates about 3 times this year. It's just going to start a little bit later in the year than what the markets want. We have seen a lot of inflation numbers actually come back a little bit hotter than where we planned. So we're actually, as of yesterday, the 10-year Treasury was running at 2024 highs. So we were seeing rates, average rates on 30-year loans just a little bit over 7%. Today we're getting a little bit of a breather on that because some of the unemployment claims came in high. But so we're seeing rates run in the higher 6% range right now. Your 15 years are going to be looking something closer to 6. And we're going to continue to watch these things because it's still very market driven until the Fed actually does something. and shows some direction other than saying we need more evidence that inflation is going to reach our 2% target. Once they actually take an action, we should see more of a set direction for rates. But right now we're seeing rates bumping back up to some of the 24 highs. And hopefully we're getting a big jobs report tomorrow, and then we'll get some more inflation data next week. So a couple of good weeks to watch out for things on, but rates are running at about 2024 highs right now.
Okay, gotcha. So we will be back on schedule as normal, and we will update you with all this information next week as well. Anything else,
All right,
Steve?
guys, have a good one.
Take care.